Guys, like I said, we're talking about you and your money. We're talking with Timothy Gilliam. Tim has been a practicing public accountant since 1983. He's also a partner and president at the Gilliam Associates PC. He specializes in taxation, personal service corporations, trusts, estates, and estate planning. Timothy, welcome to the show.
Hi, Bert. Thanks for having me.
Excellent. And am I pronouncing it correctly? It's Gilliam?
Gilliam or Gilliam, either way. We answer to both.
Okay. All right. Well, let me ask you this. What tax deductions continues to be available to me and our listeners for 2012?
For 2012, we still have time this year to take advantage of some things that are available to us to either reduce our taxes or pay lower taxes in light of the, every day we're hearing about the fiscal cliff. And so we are all pretty well sure we're going to get higher taxes next year. But what can we do this year? One of the things that's still out there that is available that many of our clients are doing has been to convert their IRAs to Roth IRAs. This increases your taxes, but may reduce your taxes in the future. So you're going to pay your tax now on your IRA in order to let it grow tax-free and come out tax-free when you do take it out. It's a nice advantage, especially if you're in a, under 70, 75. If you get older than 70, 75, you have to start really looking at those numbers. So converting your IRAs is an important item. Making charitable contributions. There's still time to make your charitable contributions this year to reduce your taxes. Next year, you may lose those charitable contribution deductions because they're going to reinstate the phase out of itemized deductions, and so many people will not get a benefit of their charitable contributions next year where they might get them this year. One of the
Let me
other
ask you
items
this, because you mentioned the regular RIA versus the Roth. So right now, in a regular RIA, I pay no taxes when I make a deposit, but I pay taxes when I take money out, and the Roth IRA is the reverse. Is that right? What's the difference?
In a regular IRA, you get a tax deduction, perhaps. Sometimes if your income's too high, you do not get the deduction, but you will put the money in for deduction or no deduction. It will earn tax-free, and the earnings will come out taxable, and the contribution will come out taxable if you got to deduct it. As opposed to a Roth IRA, you will earn tax-free, the earnings will come out tax-free, and the contribution will come out tax-free because you did not take a deduction for putting it in. And there are some other huge advantages. Roth IRAs do not have to be taking required minimum distributions at age 70 and a half. And many people can consider you leave them if you don't need the money until you're 90, 95. Your children can inherit them. They continue to earn tax-free, but they must begin to start taking them at that time. But they'll earn tax-free and come out tax-free. And so picking up that extra 50 or 60 years of earning tax-free is a phenomenal advantage to the Roth IRA.
Gotcha. What about equipment purchases? How can equipment purchases affect taxes for, let's say, 2013 or 2014?
You bet. That's one of the big changes, and something that you can do to drop your taxes this year in your business, in your medical practice, dental practice, or any business. We still have a good Code Section 179 expensing deduction available to us for 2012 of $139,000. 2013, that drops to $25,000. Also,
wow.
That's a huge drop till next year, and so this is the year to buy your larger equipment items. But also, we still have what's called 50% bonus depreciation, and that's available to the end of the year. You purchase a piece of equipment, you have a 50% deduction you can take right off the top, and that's above and beyond the Code Section 179. So you can take your Code Section 179 deduction and after that take 50% on all those assets above 139 or you could elect just to take the bonus depreciation. But 2013, the bonus depreciation goes away. And many people like this bonus depreciation and Code Section 179 for vehicles in their businesses. And so these would apply to especially the SUVs that we have here in Texas. I know, Bert, you're here in Houston, and over here in San Antonio. We've got a lot of SUVs in Texas. In your business, you can depreciate that 6,000-pound SUV a lot faster this year than you will be able to next year.
Gotcha. Let me ask you this. Go ahead.
There's some other things you can do this year to drop your taxes. Use your credit card. You can use your credit card to prepay some expenses. If you charge a credit card expense this year, it is deductible, and you can wait to pay it till next year. So,
that's a nice little trick.
It is.
So ideally, if you have the right credit card, you would pay off your expenses with your credit card, and hopefully get travel points or some kind of reward points as a bonus.
That's correct. We always recommend in the businesses that we advise to that if they're always going to be using credit cards for different items, pick a really good travel card. Here in Texas, you and I would see a lot of Southwest Airlines cards. Those are always useful. Build up your miles and take some free flights.
I love it. All right. What about medical practices or practitioners, and what do you have for them as far as minimizing their tax burden?
Specifically to medical practices, they're to help prepare them for these tax increases. The first thing we always think about is, well, how can we defer income? Retirement plans. You want to make sure first you have a retirement plan, that you're maximizing your benefits in your retirement plan, and you might have to sometimes revamp your retirement plan to do that to try to get a higher contribution. So that's one of the items is look at your retirement plan, look at putting one in place if you don't have one, revamp it if it's old, but retirement plans are going to become more valuable. Over the years, we've been allowed to put a little bit more and more into these retirement plans, and it's very important that you defer that money into the retirement plan. There's another big item that we like to look at in medical practice is trying to shift your income to other members. You can shift income to your wife and fund retirement for her in your business, in your medical practice. You could also shift income to your children, assuming they're working for you in your medical practice. And that's often
so when you say shift income, you're assuming that your wife and your kids are working for you on some basis.
That's correct. A wife oftentimes is a medical practice manager in the office. If she's working in the office, you can now fund her retirement, which would afford you another $20,000, $30,000 a year in retirement deductions for that spouse. The children are scanning documents, answering phones, shredding, office work. You can pay your children, and that shifts that income to their tax bracket, and that money is now available to fund Roth IRAs for your children or fund college education accounts for your children, or whatever else you're saving for those children because they're now working, but you've moved that money out of your high 35, which is going to be 40% tax bracket next year, down to their 15% tax bracket or less.
I love it. Now, but this would take place with anybody, wouldn't it, that owns a small business?
That's correct. Anybody has a small business that they control their books, where they can employ they own that, they have the opportunity to employ their spouse or their children in that business, assuming they're, providing a service and working.
Right. No, I love that. Let me ask you this. What do you see as far as new taxes that are scheduled to take effect in 2013 and in 2014?
We know for sure what's happened. We have the new Medicare surtax, and that starts next year, and that's the 3.8% Medicare surtax, and that surtax is going to apply to everyone over $200,000 or over $250,000 if they're couples. That's a smaller threshold if they're married filing separately of $125,000, but this 3.8% Medicare tax will apply to all investment income like interest, dividends, capital gains, annuities, royalties. It does not apply to tax-free investments like your municipal bonds, and that's important. You would like, that's something you'd want, and it also will not apply to your retirement plan distribution. So a retiree being forced to take his retirement at age 70 who's over $200,000 of income and has to take his retirement, that retirement distribution would not be subject to the 3.8. So those are new taxes that going into effect next year that we must be ready for. And of course, you might have heard this explained as, these are the Obama health care, taxes, the 3.8% Medicare surtax to help pay for Obamacare. We also have a new tax that's a surtax on earned income, which is a 0.9% Medicare tax. And this is for everyone who makes more than $200,000 a year or $250,000 for married couples. And they're going to put this on your tax return to calculate it. Some employers may take it out of your paycheck, but if they don't, IRS is still going to calculate it and make you pay it, but you're going to pay an extra 0.9% Medicare tax on your earned income over $200,000. And the thinking there is right now Medicare taxes are 2.9%. So if you add 0.9 to that, that gets you to 3.8, a familiar number to the 3.8 they're charging on the unearned. So those two taxes we are committed to till next year. What the fiscal cliff is really talking about is, well, are the tax rates going to go up also? And also what kind of phase out of deductions we're going to have. But we are facing those new increases in taxes now for 2013, and those will be in effect for 2013 and 2014.
Gotcha. Let me ask you this. We've got about a minute to go, but I'm intrigued by this. Obviously, you work a lot with medical professionals. So what is the new medical device tax, and how will that affect practitioners?
Real good question, Bert, and this is something that's kind of a little bit scary because people hear about it. They don't know what it is, and especially the doctors and dentists that are getting, at the end of the year they're asked, buy this piece of equipment or you're going to get charged the tax. And so they don't know what it is, and they get scared, and they go ahead and buy the piece of equipment, so they think they're saving money. But part of Obamacare has instituted a new tax, but it's an excise tax on the manufacturer. And so if I'm selling medical equipment in my business and I have medical equipment in my inventory, they're going to collect a 2.5% tax. It's actually a 2.3% tax on my inventory. But what's going to happen is I'm going to try to pass that tax on to my buyer. And so if I can sell you that equipment this year, I can save you the 2.3% tax. But if I have to sell it to you next year, I'm already had to pay 2.3% more to the government on that piece of equipment. So,
man, I just cannot believe all the changes that are coming down the way here. It's going to be incredible.
We're going to have a busy next 3, 4, 5 weeks. We're looking at the news every day, just kind of watching, seeing what's going to happen, like a lot of other people are.
I love it.
It's very
all right, Timothy
time.
Gilliam. You can check him out. If you have questions, you can check him out at Gilliam. That's GILLIAMCPAPC.com. Tim, thanks so much for stopping by.
Bert, thank you very much for having me.
You bet.
All righty.